Welcome to the Deep Wealth Podcast, where you learn how to extract your business and personal deep wealth. I'm your host, Jeffrey Feldberg. This podcast is brought to you by Deep Wealth and the 90-Day Deep Wealth Experience. When it comes to your business deep wealth, your exit or liquidity event is the most important financial decision of your life. But unfortunately, up to 90% of liquidity events fail. Think about all that time and your hard-earned money wasted. Of the quote-unquote successful liquidity events, most business owners leave 50% to over 100% of the deal value in the buyer's pocket and don't even know it. I should know. I said no to a seven-figure offer and yes to mastering the art and the science of a liquidity event. 2 years later, I said yes to a different buyer with a 9-figure deal. Are you thinking about an exit or liquidity event? Don't become a statistic and make the fatal mistake of believing the skills that built your business are the same ones to sell it. After all, how can you master something you've never done before? Let the 90-Day Deep Wealth Experience and the 9-step roadmap of preparation help you capture the best deal instead of any deal. At the end of this episode, take a moment and hear from business owners like you who went through the Deep Wealth Experience. Stephanie Walter is a legacy cash flow specialist, capital raiser, syndicator, real estate investor, and CEO of Airbay Wealth. Prior to founding her investment group, Stephanie followed her dream of being an entrepreneur and started her own insurance agency. It was one of the largest, most highly awarded agencies in Colorado. She recently retired and sold her insurance agency of 16 years by following the key principles she now teaches professionals to use. Over years of working with her investors, Stephanie discovered that the very wealthy view and use money differently than the rest of us. They actively have their money working for them, sometimes at several places at the same time. Stephanie realized these strategies can be used by anyone, not just the rich. Her passion is teaching people to unlearn what most of us have been wired to think about money and re-educating people on attaining wealth that can be passed on to the next generation. Stephanie's goal is to connect her select group of investors with investment opportunities that she's found and vetted to be extremely desirable. And at the end of the day, Stephanie's looking to help her investors reach their financial goals. Welcome to the Deep Wealth Podcast, and you heard it in the official introduction. We have an author, a thought leader, business owner, entrepreneur, you name it, she's done it. And I have a rhetorical question for all of you listeners out there in Deep Wealth Land. Would you like to become wealthier? Would you like to know how the wealthy become wealthy and why the rich get richer? That's some of the things that we're going to be talking about, but I'm going to put a pause on it right there. Stephanie, welcome to the Deep Wealth Podcast. An absolute pleasure to have you with us. And Stephanie, I'm really curious because there's always a story behind the story. What's your story, Stephanie? What got you from where you were to where you are today?
Yeah, well, thank you for having me today. I started out like most people out of college, went and got a W-2 job and worked there for a period of time before I realized that I was getting a 2% raise every year. And I remember I calculated that out over the rest of my life. And I talked to my father, who was definitely my mentor, and just said, Dad, I don't know. I mean, what if I make 2% raises for the rest of my life? He said, well, you can do that. You know what you're going to get if you stay in the corporation, or you can work for yourself. And the limit is really up to you at that point of what you achieve. So I started a insurance agency at that time and ran it for about 16 years. All along that same period of time, I invested in a lot of single family homes because that's kind of, I didn't really know much. But I wanted to acquire. And then in 2016, I was invited to a boot camp that talked about syndications, real estate syndications. And that was the first time I'd ever heard the concept of syndication, which just means a group of people buying something bigger than any person could do on their own. And I love that concept. And so I did a bunch of training, started doing syndications in 2018. Me and my partner have closed on 12 syndications. We've acquired over $300 million of assets under management. My part of the partnership is raising money from investors. And as I started doing this, I started realizing that wealthy investors think very differently than most of us, myself included.
Mm-hmm.
And once I really kind of examined that and figured out what they were doing, I shifted my mindset and my philosophy around a bit. And I was able to sell my insurance agency in 2021. And just kind of, I wrote a book and really want to open people's eyes to what's possible out there.
Speaking of your book, for our listeners, we'll have that in the show notes, Shattering Money Myths, How the Wealthy Invest, and we'll have a point and click. It'll be a link there. But Stephanie, before we go into what you're doing today, let's go back almost to the beginning, because you said something interesting, and I'm speaking to you now, one business owner to another. You had an interesting thought. You were forward thinking enough. You said, okay, I'm getting a 2%, and if I just get 2% the rest of my life, probably not going to take me where I want to go. And I'm wondering what even had you have that thought to begin with, and why I ask that. I'm just curious about your thought process. So many people just accept what's in front of them. Well, I guess that's just my lot in life. That's the way it is. And I'll figure out how to work within that. So what was different for you?
I have to say that my dad was an entrepreneur as well and a real estate investor. And so I did always see somewhat my parents running businesses when I was growing up. So I think that definitely made me think that something else was possible, and definitely gave me the heads up of knowing that this wasn't my lot in life type of thing. So again, it comes back to mindset. I saw other people do it and I believed I could.
Congratulations and good for you. And so let's now circle back. You mentioned mindset, and it's a terrific segue. So the wealthy and how the wealthy become wealthier, how they invest, how they think. You said you saw a different mindset from how initially you even looked at things. You've changed it, obviously. So what's going on with that? What were some of the early signs that you saw, hey, this person is different from other people? This is a wealthy mindset. This is a wealthy investor with a different mindset. What's going on there?
Well, I think there are two different things. One is wealthy people tend to have an abundance mindset, which is kind of it's a very generous mindset, believing that there's enough for everyone out there, as opposed versus a scarcity mindset where you believe like there isn't enough for everyone, and whatever you take for yourself, you're taking from someone else. And that was one step, and I kind of was, I think, in the abundance mindset. But the bigger one is I was in an accumulation mindset. And that's pretty much most of the country is in an accumulation mindset, and that we're taught we need to accumulate a bunch of stuff. For me, it was single family rentals, but for most people, it's their 401ks, and they acquire and accumulate that money and just work to get their little nest egg ready. And they get to their magic number and then they retire. Whereas the wealthy person looks at money and a utilization mindset. They feel that their money should be used and controlled within their control. They know what it's invested in. They know what the strategy is. They know what they're going to be doing, and they know what that money is going to do for them, whether that be cash flow, appreciation. They even go as far as to know what their tax ramifications are before they even start investing. So very few wealthy people that I've ever met have funds. They have maybe a very small percentage of funds in tax deferred investments, but by and large, they're investing with their own money. And at the end of the deal or whatever they're getting into, that they will deal with the taxes. And they usually have a plan of how they're going to do that before they even get into the deal.
Got it. And so when it comes to the wealthy, and you mentioned taxes, so it sounds like how the wealthy are dealing with taxes from what you've seen, maybe even where you were before, it's a different way. So for most people, when it comes to taxes, what are they doing perhaps that they shouldn't be doing?
Well, I think it comes down to everybody. There's like usually people reference three buckets of money. There's taxable, that's what's in your checking or savings account. There's tax deferred, that is the problematic part of America, where most of the money is in tax deferred investments. And then there's a third bucket, which is tax free. That is almost always significantly smaller than the tax deferred if they're utilizing that at all. So Why do I care about the tax deferred bucket being so big? Because most people have no idea what we've heard, that there are tax problems, that we have a deficit, we have a huge loan that's outstanding. But people don't really realize the extent to how bad it is, and actually historical tax rates over time. Most people, if you ask them, are tax rates historically high right now or historically low, will say, gosh, they can't go much higher than this. And the truth is, they were in a 50-year low of tax rates. When the income tax was rolled out in 1913, they said, when we introduce this, it'll be 2%. It's transitory. We're going to get rid of it. We're just helping to fund the war. Within a short period of time, I think 3 years, it was up to 80%. Marginal tax rate. It got as high as in 1945 to be 92%. So actually, if you average the historical tax rates, it's about 58% marginal tax rate. Right now, for perspective, we're at a 40% marginal tax rate. So that people need to know that taxes will probably get worse before they get better, or if at all they get better.
And you have to love those famous last words. Oh, just temporary. Don't worry. It'll go away at one point in time. And here we are all these years later. So let me ask you this. You've painted what really sounds like a bleak picture for most people. And the irony is they probably don't even realize that they are where they are. So Stephanie, let's do a quick thought experiment for the benefit of our listeners. I'm hearing you talk and, oh, you know what? I'm going to call up Stephanie. I want to really be wealthy or have more wealth, accumulate more wealth. I want to invest like the wealthy. I want to think like the wealthy. Stephanie's going to help me. So what does that look like? How does your system work? What are we doing?
For people that contact me, first of all, they can get a free copy of the book. Secondly, they can go on an email list. I try to send out lots of educational material, as well as there's a lot on my website as far as educational material. The best way is to contact me, and we just kind of go through what your financial picture looks like and what are some things that I would suggest possibly doing with differently than what they are now, or at least make them aware that these are problems that they will probably face in the future that a financial planner hasn't told them about.
And so talk to us about that. So what are financial planners either not telling us, or they just don't know what they don't know, or perhaps they even don't want us to know? What's going on with that?
Well, it's startling, but I just saw a survey done, and there's 43% of people that are going to retire believe that they will be able to take 10% out of their little nest egg. So let's use $1 million for this example. But the most recent survey was done by Morningstar Consulting Firm. They're an independent contracting firm. And they did a study, and they said that number is more like 2.8%. There's also other people that are starting to say about 2%. The reason why that number is going down so much is because the longevity is going up for most people. So that in that example, someone thinks they're going to be able to take 100,000 out. In reality, they can take $28,000 out. And it's very possible that that $28,000 is going to be taxed possibly higher, 40, 50% than what they think. And this is all about making people aware of these things, because I just think that financial advisors really focus on accumulation, but they don't focus on how to distribute the money for the rest of their lives. And that's really the whole reason we want to accumulate money, is to have a good retirement.
Absolutely. And so, Stephanie, hearing all of that, so what does that look like now? So you speak with a potential investor who becomes a client of yours, someone even from the deep wealth community as an example, and there's a synergy there. It all makes sense. What would happen next?
It's possible that I look at everything, and it's possible that they have like a 401k, they want to stay in that, and I'll advise them to move money into an index fund, something that, and make them aware of what kind of fees they're paying and stuff like that. I'll also see if they could qualify for Roth
Mm-hmm.
products, but unfortunately, most people make too much money to do that.
Okay.
But there are amazing strategies, again, that the wealthy have been using for years. One of which is tax-free retirement income that can be generated by life insurance, of all things. But
Mm-hmm.
it's actually something that the wealthy have done for years and continue to do for years.
And so, speaking of that, let's just pick perhaps the top two or three things where there's differences. So, for the wealthy or the wealthy investor relative to the rest of the population, and you just shared one area where, okay, the wealthy look at it differently, they're doing things differently than most other people. What are some low hanging fruits that, when working with you, we begin to appreciate as we move towards from a regular investor, maybe even a non investor, to becoming a wealthy investor?
Well, I think a big myth that I go into in my book is that the reason the wealthy become wealthy is because they choose to invest in very high risk investments. And actually,
Mm-hmm.
nothing could be further from the truth. They ascribe very much to Warren Buffett's famous quote, which is don't lose money in your investment. Rule number 2, don't forget rule number 1,
Sure.
because I show in my book how significant it is when you go through a loss in the stock market.
Mm-hmm.
Whereas many people think that if they lose 50% on their investment, they need to just make 50% to get back to where they were.
Mm-hmm.
And that's absolutely not true. So, yeah, I like to educate them about investing in things that are a bit more low risk, thinking long term, but also really understanding what they're investing in, taking back some of their control from the financial planner. Because notice that the wealthy people, they invest in companies, they invest in real estate, but they know, if they're investing, say, in private equity or something like that, they know what companies they're investing in, who's running these companies, what exit strategy of getting out of the company. Same
Mm-hmm.
thing with real estate syndication. They know all of those things because the more they know, the more control that they can feel that they control their investment, as opposed to like someone who invests in mutual funds. There could be hundreds of them, and the average person can't even name one of the companies, or if they can, they can't tell me who's running the company and what their long-term strategy is, if they're, what the strategy is for this company.
So it sounds like one of the takeaways for our listeners: know where you're putting your money towards. Know the company, who runs the company, what their philosophy is, what's going on, how's your money being treated, what's your return on investment going to look like. And so, with that said, Stephanie, talk to us about real estate syndication. So, what's going on with that? Because I know that's a big role in what you're doing. And for a lot of investors, like you're saying, it's, well, you know what, I don't really know much about this, so I'll just put it into a mutual fund or into some kind of note or into some other kind of stock that everyone else is doing. So, what's going on with real estate syndication that we should know?
Well, real estate syndication, again, is one of those strategies that's been around forever, but it's most recently been available to the average investor. In 2012, there was a part of the Jobs Act that was passed
Mm-hmm.
that allowed fundraisers or people that run companies that do syndications for them to be able to market to strangers, as strange as that sounds, because before that, if you ran a syndication and you needed to raise money for it,
Mm-hmm.
then you would have to only go to people who you had prior relationships with. And they opened this up in, like I said, 2012. So syndication is just a professional group of people that buy, let's say, an apartment complex
Mm-hmm.
in Florida, and they buy it under market. They bring investors in at a much lower price point than if that person wanted to go out and buy a $10 million apartment complex. They can invest in and be a partial owner for 50 to 100,000. Okay.
Mm-hmm.
Yet they get all the benefits of when that cash flow, when they receive the rent every month, they get a portion of that rent as their cash flow.
Mm-hmm.
And then I'm just going to go from what we've done, which is we buy properties that are undervalued and we add value to these properties by either renovating some of the units
Mm-hmm.
or by just simply straightening up the management. because the beauty of commercial real estate is the value is not based on, say, a house that's right next door to you that sells for way less. The way that commercial real estate is valued is by how much income it produces. So that makes it very appealing if you can buy in markets that are growing. And then when we hold usually for 3 to 5 years, and then once we sell it, you get your initial investment back. I don't know. What we've done in the past has been usually a 25% return each year after that. So we try to double our clients' money, but it could be higher or lower depending on what types of real estate you want to invest in. But that's a perfect example of being able to know the team that's running it, see their experience, see what they've done in the past, and choose to invest with someone who you feel confident in investing with.
So Stephanie, what it sounds like you're saying, and you can tell me if I'm on base, if I'm off base with this, with a real estate syndicate as an example, working with you and the team, it's like being a fractional owner.
Yes.
And so whether it's 50,000, 100,000, more than that, less than that, whatever that is, you're part of a group of investors. Each of you owns a smaller piece of the pie, but perhaps it's a larger pie than you'd be able to do on your own. And perhaps there's safety in numbers because you have someone like yourself and your team, you're a professional management team that you're running that. And it's more on the commercial side of things. It sounds like, is it strictly commercial? Is it residential? Is it both that you're looking at? What are you doing?
We do commercial, but there are some groups that go out and buy a bunch of rental homes and combine them together, and then a syndicate buys them. But no, we like the multifamily. We like looking in areas of the country that are growing. And there is actually quite a lot of, there's not enough housing.
Okay.
I think most everyone knows that. But so housing is a great place to invest because there seems to be a shortage and we're always growing.
And so let me ask you this, in where we are right now, as rates have gone up, and I know, like you're saying earlier, you're spot on. For most people, they're saying, wow, this is as high as it's going to get. Historically speaking, this is still fairly low. How's that impacted the market from where we were to where we are today?
Well, for us, we've stopped investing right now. Our last acquisition was in 2023. Okay. We closed on 3 deals in early 2022. Yeah, that's what we see as well. The interest rates are going up depending on who you listen to. Nobody really knows what's going to happen, but we've certainly heard, we think interest rates are going to continue to go up. And so unless we can assume a loan or just find a property, that it's much harder to make a property work in this environment. But the good and bad news is that a lot of people do syndications, and they didn't really, I don't think anyone really saw this interest rate environment changing this dramatically. So there are a lot of people that have bought multifamily units and they didn't get long-term debt. So that just means that they got maybe a 1 or 2 year bridge loan or something like that. So when their loan comes due, this is what everybody thinks at the end of this year, possibly the beginning of next year, they're going to have to refinance. They won't be able to really keep the property, and because they won't be able to fulfill what they told their investors. So there's going to be some distress selling, and that's what we're holding out. And because we never want to put out a deal that is not a good, solid deal. We've always had good, solid, long-term debt in our deals, but which has been very good for us. But there's always opportunity in real estate. So if you can always buy at a good rate, but certainly, yeah, this is taking time for us to pause before we go in and see what's going to happen.
And Stephanie, I'm wondering, as you're talking about this, if you can shed some insights or some strategies for our listeners, because for many of our listeners, they have what we call a deep wealth, the golden handcuffs. And you know what that is. With your insurance company, being an entrepreneur, a business owner, your wealth is really locked into the business. And I can just, in my mind, I'm hearing some of our listeners saying, you know what, Jeffrey, Stephanie she has a great story. She's doing some wonderful things. How can I somehow be a part of that, though? Because my wealth is in my business. Every extra dollar I have, I'm putting into my business to have it grow. My business is my best investment. And one of the things that we do at Deep Wealth in our 9-step roadmap, when it comes to the advisory team, step number 6, we actually encourage business owners before a liquidity event speak to different advisors, bring them on the team, a wealth advisor as an example, an investment advisor, so that you're not only and solely in the business, but you have no guarantees, obviously, but you have some other outlets in addition to your business. So for a listener who is thinking to him or herself, okay, sounds good, I'd like to diversify, but how could I do that when my money's locked up in the business? Any thoughts or suggestions? I know you've been there, you've done that, so what would you have to say?
Oh my goodness. I mean, it sounds like what you do is incredibly helpful for getting people's money out of their businesses. For me, I had a goal that I wanted to purchase a certain amount of real estate every year. And I took, instead of me contributing to, say, a 401k or something like that outside of my business, I just kept my sites pretty strong or kept it pretty small. And over time, something can grow pretty quickly. So I say for people, even if you only have $25,000, something like that, you can commit to what you're wanting to invest in. Mm-hmm. There are certainly deals that you could get into for $25,000. In addition, during this period of time where we're kind of like we're on a holding pattern right now, is certainly looking at these other investment options that the wealthy do. Specifically, I was thinking of the getting tax-free retirement that's funded through a life insurance policy that's tied to the stock market. So that even if you could put in, and you could run the numbers both ways, but certainly that's a great option for people to even start putting this small amount of money in, like $25,000 for 5-6 years would really set them up with a nice retirement. But yeah, it's, as far as I hated that, to be honest with you, when I owned my insurance company, you would have great years. We had great years, but we did have some years where I was just not experienced and I made like an oopsie. And I was like, gosh, I need like a few $1,000s just to carry me, because I wanted to be sure everybody got paid every month. And you go into the bank and it was like, holy cow, they were not that helpful to pull money out of your business. It's kind of difficult.
Sure, yeah.
So, I mean, they treat you like we had been with that bank for a long time. We'd had a great history with that bank. And still they're like, you can fill out this whole big thing and then we'll put you in our, trying to figure out how much money you can get out. But yeah, no, that was not fun. So
sure. And so what I'm hearing, and for our listeners, what Stephanie's suggesting is a terrific strategy. One of the powers of being a fractional investor, and we're doing this in our businesses, we bring on fractional executives, perhaps a fractional CFO, a fractional marketing person, a fractional president, a fractional whoever. Well, now we can do that in ways we couldn't do before from the investment side, where you don't need a gazillion dollars. And for all the business owners out there, could you put aside a few $1,000s a month, $2,000 a month, $3,000 a month? There's your $25K at the end of 12 months, or maybe you can do more than that. Terrific. Whatever works for you, that's the best plan. That's the way to go. So Stephanie, what I'm hearing you say is, hey, you don't have to go big. Start small. See how that goes. And I know for some of our listeners, my ears perked up. Stephanie, you're saying, wow, usually we get a 25% return each year. And has that been something fairly consistent for you, or what's been going on with that?
Yes. Every deal we've done has returned, over 20%. We've had one that's returned over 30%. One we're selling this year, which is, I think, not typical. It just happened to be like a great deal. At the time, is going to be returning 40% a year.
Okay.
So usually these rates are much higher. Well, they are much higher than REITs, which are stocks that you buy and invested in real estate. And the benefit actually that I just thought about, but is that you get some great tax benefits investing in this, because you are a fractional owner. So therefore you get depreciation. So even though you've made money all throughout the year, every month you get a check for, I don't know, $200 or $300, then at the end of the year, you get a K1 that shows a depreciation amount, a loss, in fact. So that could be a way that someone ends up freeing up a little extra money too. Unless you get in and try it,
Sure.
You're going to be behind.
I hear you loud and clear. And Stephanie, with that, so through real estate syndication, as an example, you're saying, listen, we've had returns anywhere from 20% to 40%. So from $1 that's gone in on day one and all the way through to the return, What kind of time frame are we talking about? What does that look like typically?
Well, typically for these properties we're selling this year, that's been 3 years of an investment. But as the market's changing and stuff like that, I would say 3 to 5. I tell all my investors plan on this being a liquid for 3 to 5 years. But you double it in 4 years and you roll it over again.
And that's a key. And for listeners, I hope you picked up on that. So it's not put my money in today and 12 months from now, out it goes and it's 20%, 40% higher. It's 3 to 5 years. But Stephanie, and I'm sure this is a habit of the wealthy, when they finish one investment, they just keep on rolling it over into the next one, into the next one. And the beautiful thing about compound interest, eighth wonder of the world, it just keeps on growing with that. And before we go into wrap-up mode, I have another question for you, because I know in the investment world, there's a few different camps. And one camp says, you know what? I don't care if you have the best financial planner, the best real estate syndicate, the best wealth advisor. No one can beat the market year in, year out. And the best thing that you should do is just buy an index. So I'm going to pick a very simple one. Buy an index for the S&P 500 and you'll always win. You'll always be ahead. Yeah, it's a long game, but at the end of 5 years, 10 years, 20 years, you're so much further ahead. And I'm not saying that's right or wrong and no judgments there with any of that. What would you say to that school of thought?
Well, I think everyone, and this has been ingrained in our heads, they tell us to diversify. But I don't believe when I look at how the wealthy, when I look at their financial statements, they're not diversifying within the stock market. Yes, they own some stocks, but certainly they're looking at diversifying in real estate. They're looking at diversifying in private equity. What that means is just investing in businesses, tangible things. So yes, I think, and then diversifying in these other products that previously most people have never heard of, like life insurance or other products that can build wealth as well. So no, I think that consistently you don't see a great deal of people's money invested in that. But I do believe, yes, there's much better returns in the indexes. And I tell people to take their 401k money and put them in those indexes so that they can reduce the fees that are coming out. And the indexes traditionally beat what any other money manager is doing, I think 93% of the time. But certainly investing in all these different, like I was talking to one of my favorite investors the other day, I say, how much you put in every investment you do? He says, I don't put any more than 10% of my money in any investment. And that is, to me, true diversification.
Yeah, some great answers there. And let me ask you this, Stephanie, before we go into wrap-up mode, because again, any one of these areas, we could just go down a rabbit hole and talk for hours on that. Are there any questions that I didn't ask, or any topics that we haven't spoken about that you'd like to share with our listeners? Anything that you think we've missed or didn't go into enough detail that would be a benefit to our listeners?
I mean, I think we've covered a lot, and almost everything that I've talked in my book about as far as mindset and some different options of investing, as well as the stock market, talking about indexes and being aware. I guess one other thing is that a lot of people, when they leave a company, because people just usually don't work at the same company for 30 years anymore.
Sure.
And they have a leftover 401k and they just leave it there. That can be very bad, because you're not aware of what it is invested in, and you don't have any control over it. You don't know what the fees are. Most people don't. But certainly that, because it's from your previous employer, you can take that and turn it into a self-directed IRA. So if that has like any type of money, that the $25,000, $30,000, that you could put that in a self-directed IRA and you could start your investing from that one.
What a terrific tip. And for our listeners, I hope you were paying attention and picking up on that. What a great takeaway that is. And speaking of takeaway, Stephanie, let's go into wrap-up mode. And I really mean it when I say this. I have the honor and the privilege for every guest to ask this question. It's a fun question. Let me set this up for you. I want you to think about the movie Back to the Future. And in that movie, you have that magical DeLorean car that can take you to any point in time. So here's the fun part, Stephanie. Tomorrow morning, you look outside your window. Not only is the DeLorean car curbside, the door is open, it's waiting for you to hop on in, which you do, and you're now going to go back to an earlier point in your life. Stephanie, as a young child, a teenager, whatever point in time it would be, what would you tell your younger self in terms of life wisdom, life lessons, or hey, Stephanie, do this, but don't do that? What would that sound like?
Wow, that's a great one. I think for sure, just don't wait so long to do, because I stayed in the W-2 world for about 8 years before I'd had it and gotten out of it. I wish my older self could say, you're going to be just fine. Go out there. Don't be scared. You're going to do it and buy real estate faster than you were. Don't wait so long. Don't wait until you were in your 30s to do that. Do that in your 20s.
Terrific life advice. And for our listeners, I hope you picked up on that. This is what I love about the Deep Wealth podcast. This is advice from the trenches. You've been there, you've lived through it, you've seen both sides of that. And Stephanie, for our listeners, we'll have all this in the show notes. If someone has a question or they want to reach out to you, they want to learn more, maybe even become part of the syndicate the next time that you're out there with some properties, where's the best place online for someone to find you?
My website, which is www.erbewealth.com, and that will take you to where you can download a book for free. But there's also a page in there where you can contact me and set up a time to talk. I'm always happy to talk to people and get to know their particular situations. And even if we don't have anything available at that time, it's at least nice to touch bases and maybe come up with a strategy.
Oh, terrific. Doesn't get any better. I encourage all the listeners, take Stephanie up on her offer, visit the website, get the free book. Doesn't get any better than that. Reach out, have a conversation. Well, Stephanie, it's official. This is a wrap. And as we love to say here at Deep Wealth, thank you so much. And thank you for the insights, the wisdom, and may you continue to thrive and prosper while you remain healthy and safe. Thank you so much.
Thank you.
The Deep Wealth experience was definitely a game changer for me.
This course is one of the best investments you will ever make because you will get an ROI of 100 times that. Anybody who doesn't go through it will lose millions.
If you don't have time for this program, you'll never have time for a successful liquidity.
I mean, it was the best value of any business course I've ever taken. The money was very well spent.
Compared to when we first began, today I feel better prepared, but in some respects, maybe less prepared, not because of the course, but because the course brought to light so many things that I thought we were on top of that we need to fix.
I 100% believe there's never a great time for a business owner to allocate extra hours into his or her week or day. So it's an investment that will yield results today. I thought I will reap the benefit of this program in 3 to 5 years down the road. But as soon as I stepped forward into the program, my mind changed immediately.
There was so much value in the experience that the time I invested paid back so much for the energy that was expended.
The Deep Wealth experience compared to other programs is the top. What we learned is very practical. Sometimes you learn stuff that is great to learn, but you never use it. The stuff we learned from Deep Wealth experience, I believe is going to benefit us both.
I've done an executive MBA. I've worked for billion-dollar companies before. I've worked for smaller companies before I started my business. I've been running my business successfully now for getting close to a decade. We're on a growth trajectory. Reflecting back on the Deep Wealth, I knew less than 10% what I know now. Maybe close to 1% even.
Hands down, the best program in which I've ever participated. And we've done a lot of different things over the years. We've been in other mastermind groups, gone to many seminars, workshops, conferences, retreats, read books. This was so different. I haven't had an experience that's anything close to this in all the years that we've been at this. It's 5-star, A+.
I would highly recommend it to any super busy business owner out there. And Deep Wealth is an accurate name for it. This program leads to deeper wealth and happier wealth, not just deeper wealth. I don't think there's a dollar value that could be associated with such an experience and knowledge that could be applied today and forever.
Are you leaving millions on the table? Please visit www.deepwealth.com/success to learn more. If you're not on my email list, you'll want to be. Sign up at www.deepwealth.com/podcast. And if you enjoyed this episode, if it added value, if you walked away with some new insights and strategies, please leave a review on your favorite podcast channel. Reviews help us reach new listeners, grow the show, and continue to create content that you'll enjoy. And as we wrap up this episode, as always, please stay healthy and safe.